Welcome to Money Depth Insights. I am the finance guide, John Nell. Today, we are talking about how banks really make money from you, not through conspiracy or hidden tricks, but through a system that quietly rewards predictable human behavior, small habits, and emotional decisions repeated over time. Most people assume banks make money simply by charging interest on loans. That belief is not wrong, but it is incomplete. Interest is only one piece of a much larger structure. Banks are not designed around dramatic failure. They are designed around moderate imperfection. Banks do not need people to be reckless. They need people to be slightly inconsistent. The modern banking system is built as an ecosystem. Every product, fee, incentive, and rule is designed to align with how people actually behave, not how they think they behave. Let us start with interest, but in a practical way. Interest is what banks earn when you do not pay your full balance by the due date. This happens most often with credit cards, personal loans, and revolving credit. What most people miss is that interest does not require irresponsible spending. It only requires carried balances. Even disciplined people carry balances sometimes. They miss one payment, they stretch 1 month. They choose convenience over full repayment. Each of these small decisions generates interest. Interest feels harmless at first because it grows quietly. A few dollars here, a small percentage there. Nothing dramatic. Over time, those small amounts become reliable income for the bank. What makes interest powerful is not the rate. It is the predictability of human behavior. Banks price interest knowing that people underestimate how long repayment will take, and overestimate future discipline. This is not exploitation. It is statistical expectation. Another major revenue source most people never notice is transaction fees. Every time you swipe a debit card or a credit card, the merchant pays a small fee to the bank and the card network. This is called an interchange fee. From your perspective, nothing feels different. The price looks the same, the purchase feels normal. Behind the scenes, the bank earns money. This means banks profit from responsible users too. Even people who pay their balance in full generate income for banks through transaction volume. More swipes mean more fees. More spending means more revenue. This is why banks aggressively promote card usage rather than card balances. Frequency matters more than debt. Another income stream is account fees. Monthly maintenance fees. Overdraft fees, late fees, transfer fees. Foreign transaction fees. These fees are not random. They exist because attention slips. People forget due dates. They misjudge balances. They move money without checking terms. Most fees are not intentional, they are behavioral friction. Banks earn money when life gets busy and awareness drops. Another overlooked source of revenue is annual fees on premium cards. These fees are justified by rewards, perks, insurance, and access. What banks understand is that many people do not fully use those benefits. Unused benefits reduce cost, paid fees remain income, this difference creates profit. Rewards themselves are also part of the revenue system. Rewards look like free money, cashback, points, travel perks. In reality, rewards are funded through interchange fees and behavior. When people chase rewards, they often spend slightly more, or shift spending onto the card that earns rewards. That extra spending generates more transaction fees than the reward payout. The bank wins not because rewards are unfair. The bank wins because incentives change behavior. Another revenue stream comes from promotional offers. 0% interest periods, balance transfers, introductory rates. These offers attract people who want relief from high interest. Banks know that many people will underestimate how long repayment will take. Transfer fees apply up front, interest resumes later. Optimism fuels rollover balances. Another quiet income source is data. Every transaction generates behavioral information. Spending patterns, payment timing, category preferences, risk behavior. This data allows banks to price risk accurately, target offers, and cross-sell products like loans, insurance, and investments. Credit cards often act as the entry point into a broader financial relationship. The more you use the system, the more valuable you become to the bank. Another misunderstood area is overdrafts. Overdraft fees exist because people misjudge timing. Income arrives late. Bills arrive early. Transfers fail. Overdrafts feel accidental, they are profitable. Banks do not need people to stay overdrafted. They need people to occasionally miscalculate. This pattern repeats quietly. Another income stream is interest on deposits. When you keep money in a bank account, the bank lends that money to others. The bank earns interest on loans while paying you a much lower interest rate on your deposit. The difference between what they earn and what they pay is profit. Your idle cash is working, just not for you. Another subtle revenue source is behavioral inertia. People rarely switch banks, they rarely close accounts. They rarely renegotiate terms. Comfort keeps people in suboptimal arrangements. Banks profit from stability more than from innovation. Another real-world observation is that banks do not rely on dramatic outcomes. They do not need mass defaults. They do not need financial collapse. They need moderate imperfection. Small balances, occasional fees. Frequent usage, long relationships. This creates predictable income. This is why banking marketing emphasizes convenience, flexibility, and comfort rather than discipline. The system performs best when users feel relaxed. Comfort leads to usage, usage leads to revenue. Another behavioral pattern is emotional borrowing. People borrow during stress. They borrow during celebration. They borrow during comparison. Debt increases, interest grows. The bank profits from emotional decisions. Another pattern is payment minimalism. People pay minimums. They stretch balances. They delay full repayment. Interest compounds quietly. This is not irresponsibility. It is human nature. Another overlooked area is penalties. Late fees. Penalty interest rates. Account restrictions. These are not the foundation of profit. They are behavioral sorting mechanisms. They identify risk and adjust pricing. Fees generate income while refining exposure. Another important insight is that banks are not moral systems. They are probability systems. They respond to behavior, not intention. The system does not judge you. It measures predictability. The more predictable your behavior, the more profitable you become to the bank. The more inconsistent your behavior, the more expensive your life becomes. This is why understanding the system matters. When people understand how banks make money, they stop feeling victimized. They start feeling strategic. They choose when to use credit. They avoid unnecessary fees. They pay balances intentionally. They use rewards without chasing them. They participate without feeding the most expensive revenue streams. This is not about fighting the system. It is about understanding it. Banks make money from you because the system is built around behavior, not morality. There is no judgment built into the structure. There is only probability. The most powerful shift happens when people stop asking whether banks are fair and start asking how value flows through the system. Once you see where money is generated, you can decide how much you want to participate. You stop reacting emotionally. You start reading statements strategically. You stop chasing rewards blindly. You start aligning tools with behavior. In the long run, banks profit most when users remain slightly disengaged from how the system works. Awareness changes that dynamic. Understanding gives leverage, not fear. If this explanation helped you see banking more clearly, share your thoughts in the comments. And if you believe this understanding can help someone in your colleague or friend circle, make sure to share it with them. Education grows when knowledge is shared. This video is created for educational purposes only. For more calm, practical, and long-term financial understanding, subscribe to Money Depth Insights. I am the Finance Guide, John Nell, and I will see you in the next session.